Good morning, ladies and gentlemen. Well, after a couple of weeks holiday, good to review what has been going on. We've had the expected move in equities and the risk on off model has gone to plus 32 and is very close to saying that equities are a better bet than bonds. Better late than never, eh? So here we are. We have the probably the highest weekly, daily and weekly close we've had in a very long time. The daily model is about very close to giving a buy signal, and the weekly model as well. We can see these weekly scores. We never really had a close up at 32 ever since we had those in the fifth month of the year. So we are really moving into a much better situation for equities. The deviations have actually caught the market wonderfully well and gave us some very good buy signals at the lows. We have this middle line which is slowly trending up, and what that is saying to me is that any move down towards the 29.50 area, which is the middle, here it is, 294.74, is going to catch the market, and the market, even if it goes through it, it'll trade back towards it. The sectors are the thing that are going to be very interesting. XLU, you can see how much room it has on the upside. It can certainly test the top of this area here and probably stop some people out by going through it. So we are looking for something like 65-ish in XLU. If we look at the other sectors, we have the telecoms, which basically are flat. So it would not surprise to see up and down movement in the telecoms, and the telecoms are, going to be closely related to the bond performance, which I will do later. But this is the sector that probably is going to suffer most in the next few days. XLU would not be really surprising to see it test the uptrend line, which is here around the 61.25 area. That would be normal and nothing really to be worried about. The materials are also in a range. Anything in the materials above this area of the two standard deviations around the 59.80, 59.90 is going to be a sell area. XLK is the one that actually could be the most interesting, because if you think about it, an oil shock, if it turns out to be an oil shock, is a yield curve steepener, and the steeper yield curve will actually hurt the XLK sector, and we could have XLK come down and retest these lows. To me, this center line on Monday is probably almost a given. Make a note where it is, 79.90. That is going to be the first area for a bounce. But to me, not so sure. To me, XLK has not been trading as a leader for a very long time, and the extra risk you get with XLK is not being rewarded. XLF is actually the exciting one, because if you think about it, any kind of higher oil prices are actually good for the banks for two reasons. A, it steepens the curve, which is good for the banks, but B, it also makes credit, their book, better, because they've lent a lot of money to shale companies, and the risk on that book is now much better than it was before. So there is a decent chance of continuing outperformance by XLF. And to me, XLF here was just such a great buy. I would not be a seller of XLF until we see new highs, and I certainly don't want to short it at any stage over the next couple of weeks. XLV to me is just a dead sector. I think as the election comes through and it comes nearer and nearer, XLV is going to be something that you want to avoid, because if the Democrats win the White House, XLV, I mean, the risk reward of owning it is just awful. XLP, again, it's going to be very susceptible to rates, so a backup here would be normal and something to buy. And XLY is the one that could actually get hit on Monday, simply because if the consumers have to pay higher oil prices, they will have less to spend on discretionaries. So really I would expect it to come back down to this 120.40 area, and that actually matches very well with the 29.50 area in SPX, doesn't it? The rotation is going to be very violent on Monday because of the news over the weekend. How long that lasts, who knows. XLI will certainly be a sector that I would not be surprised if it goes and tests the middle line around 76.34. We have to be surprised for some, we must not be surprised. We have to be prepared for some very violent sector rotation and a lot of money moving between sectors on Monday, simply because if this does produce a higher oil price by 10 to 20% on a stable basis, then a lot of sectors will need to be repriced going forward. And finally, I really want to show you the Russell 2000, which is a sector which is very, an index which is very heavy in both financials and energy companies. That should really outperform. The Russell should now outperform the SPX and certainly the NQ. Being long of Russell and being short of NQ could be the trade on Monday. Depends very naturally where it opens. But certainly first thing at 6 p.m. tonight, I am going to buy some Russell and sell some NQ, because, I mean, assuming that they don't open at ridiculous levels, but I will tweet. And here is QQQ. You know, what to say about it? It's still in a range, but just like the NQ, I just don't see that much upside here in QQQ. In terms of fundamental valuations, well, the market is behaving perfectly, isn't it? It's the 16 times Blue Angel and the 17 times Blue Angel, and I think we're going to be in this range for a very long time. It's going to be sector rotation. It's not going to be index moves that happen over the course of the next few days, simply because we have, on the one hand, the Fed easing, on the other hand, potentially a much steeper curve, on the third hand, much better valuations in XLF and worse valuations in XLY, better valuations in XLE, worse valuations in XLI, for example, the industrials and the transports, which should suffer from the higher oil price. So overall, a pullback in risk, but you know, the index might come down 1%, it might come down 2% over time, but the relative valuation of the sectors is going to be the big mover. Isn't it amazing how the market anticipates these events? I was really dumbstruck by how much the bond complex has moved over the past couple of weeks, and scratching my head as to why that would be so. Now, the Fed is definitely still in an easing mode. On Wednesday, we will definitely get a 25 basis point cut. And that, if the market now thinks is going to be the last one, is going to anchor the 2-year note somewhere between here and the 205, 208 area. So is the 2-year note going to rally hugely on the back of the news that we got over the weekend and the attack on the Saudi production? No, I don't think so. I think the move is going to be one of relative stability, because the 2-year is going to get caught between the risk on and the risk off. It'll be an area where people park money. Yes, so could it back up a little bit? Maybe, but I don't think it's going to be a big mover. To me, the 2-year note is now going to be between the 170 area and the 205 area, a 25-30 basis point range, simply because it's going to be far too early to tell what the long-term consequences of this are. This could be very much a temporary state of affairs, something that is resolved within a week or two. To me, the 2-year is going to be the place where people park their money while they try to decide what the next move is, and that is going to be another factor why I think the yield curve is going to steepen. The 5-year note is coming up to very interesting levels. You can see how for many, this is a weekly chart, and you can see how for many weeks this area between 177 and 187 has held the 5-year note, and even when it went through, it came back and hesitated. To me, that is the natural level of resistance in the 5-year note. I would be very surprised if it can make it through 187. I will definitely be a buyer there, if nothing else, to spread against the 10-year and the 30-year, because I really do think that the yield curve now has a chance of steepening. On the one hand, you have the inflationary shock of the higher oil prices, and on the other hand, you have the deflationary shock on the economy. So really, I think that there's very little doubt that the yield curve will try to steepen by at least 10 to 20 basis points in the short term. That's what I think. We will see how right I am. So the 2s and 5s, better buys, because we're closer to much better resistance levels than in the 10s and 30s. In the 10-year note, I was very surprised by this move that we had through 185 on Friday. It should have held the market. Now it could easily go to this kind of area around the 205 to 210. It's going to take time for people to actually figure out how long this disruption in Saudi Arabia is going to go on and what the right price for everything is. So really, I don't expect it to do much more than 205, because there is a deflationary component to what is going on as well. You can see how here it traded 208 as a top. That would not surprise at all, but I think parking money in the shorter end is a much better bet, and if wrong, you will lose far less than in 10s and 30s. TLT is an interesting chart. It could be just about to go into, if you have a look here, into a bit of a sell mode. So for the next several weeks, we could actually get a move all the way back to this very important level that I've marked here with a very thick line at 127.27. That also tells me that I'm right in my estimation that it's going to be the yield curve which takes the strain. I would avoid TLT, I would avoid the 10-year, and I will put all my longs into the much shorter end. fives, twos, and even euro dollars, there is a very good chance that if this persists, the weaker economies, you know, the ones that are most exposed to an oil shock, like DAX, because of its very high component in automotive, and don't forget that Europe has no oil, those could really get hit very hard, and the rotation between indices, markets, sectors of markets is going to be very, very violent. And really, I think it's best to stick to the plain vanilla. 10-year bonds against 10-year treasuries, very interesting. It got to my 210 level just, right? And that's the level that I thought it, and then poof, all the way back, and now it looks like we will trade 245 again. I think 245 is going to be very, very good support, and that should give us a level after which, excuse me, the 10-year is unlikely to go very much higher in yield. That will be the top of the steepener, as they say. So I will be watching that and tweeting it to you. But it still has quite some room to go, doesn't it? That is all that can be said. I would be very surprised if it goes through 245 in a hurry. Euro USD, as frustrating as hell. But fundamentally, when you think about it, this could be just the catalyst the market needs to go a lot lower. Why? Because the European economies are very industrials and auto heavy in the indices. Exactly the sectors you don't want to be in if you're going to have an oil price shock. The economy is weak. You have dissent about the next monetary steps. The fiscal steps are not in place as yet, and you have people are going to be buying krona, buying Canadian dollars, buying anything which is commodity related kind of thing, and selling the euro because they get carry. And it's doing really nothing wrong. It's just doing it so damn slowly. 111.08, it touches it, it backs off. Now, it could really come a lot lower, but it's trading very, very technically. Every time it gets oversold, it goes back up, goes to the right level, comes back off. There is just no impulsion, and that's what worries me. I've to my cost, I found out over the years that markets with no impulsion, I don't trade well, and I need basically to rethink my strategy in those. It's not something that I'm very happy saying, but it looks like this kind of area around the 109, 109.50 area is going to be tough to break until the market absolutely decides that we are going to have a fundamental change. At the moment, I see no reason to be long of Euro USD. Technically, it's doing nothing wrong, and fundamentally, it really should be going down a lot faster. The same is naturally reflected in DXY. It's doing nothing wrong. It's just that it can't stay at the top of the Bollinger Band. For the market to have a sustained trend move, the daily closes need to be at the top of the Bollinger Band, like here. It needs to exceed it a little bit, trade below it, but basically stay towards the top of it so that it opens up the Bollinger Bands. It's not doing that. It's basically trading between levels. It's playing ping pong between levels, which indicates that there isn't a strong trend in place. It's a weak trend, which is a little bit worrying, but again, there is no reason whatsoever to assume that the dollar index is about to break down. Absolutely none. The fundamental news is positive for the dollar, and absolutely no reason not to stick with longs. The one sector I will not be buying on the open is gold. Why? It's bound to open higher, right? But that's going to be just a knee jerk. I think the higher bond yields, or the steeper curve, and the fact that the dollar is going to be bid, because I don't see any reason for it not to be, are going to be dampening factors, and I think any very much higher open eventually is going to get sold into. To me, gold has reached all the objectives, and unless I see it, now start going through the highs because of it's, but it's not going to, simply because the market is going to need time to decide whether this is temporary or this is permanent. If it's permanent, yes, gold will go higher, but I don't think the market has enough information or has had enough time to digest the news to say, yes, this is going to be forever, oil prices are going to 100. I just don't see that. And in which case I am not a buyer of gold, because I think that we are probably just going to spike higher and then straight back down over the course of time. To me, the level that is the important level is still this 1,458 level. That's where all the retracements are. That's where the market really had huge trouble going through until it did. I would much rather wait for gold for a much clearer picture than the one we have at the moment. Well, oil is going to be interesting on the open, isn't it? What can we expect? Well, I would have thought the first reaction is going to be up to this 62, 60, 63, let's call it. Who knows? It's going to be very volatile. But if you have a look, this kind of 63 level was very important. 63 and a half, whatever, a very important level, and we shall probably touch it probably on the open with all the stops going off. But it's not a bad picture in oil. It's a triangle. We could really start motoring. And if we do, that definitely is going to be inflationary and or an oil shock, in which case it's ultimately deflationary, but it doesn't really matter because in the short term you get the same effect on prices. It's the long-term effect that is completely different. But we have so many weeks in which we will be able to discuss that it's absolutely no point in thinking about it. First reaction, steeper yield curve in the States, stronger dollar, and then we see. As to equity indices, I think the first move is going to be rather muted. Why? Because we have so many things that the market doesn't know about, and really it's just going to be stops and ping pong between levels. As I've said many times, we don't know the permanence of this, we don't know the severity of it. We have the Fed. Always the market likes to come back to these moving averages ahead of big news, and I put out a very small short on Friday simply because I know that is the case. To me, anywhere between 29.90 and 29.75 is where we're going to come in when before the Fed announcement. The market likes these areas. We have this very important area at 29.54, both on the dailies and if we have a look at it on the weeklies. Let me find the weekly chart. Here it is. You can see how this area has been, in every time the market busts through it, it goes higher, and that's what I told you. If we close above 29.50, do not stand in its way, and we got another 50 odd points. Now a move back towards it would not surprise, but I'm really not going to be short anywhere below 29.70 on before the Fed comes in. To me, the risk reward is just not there. I'm going to cover my little bit of short and that's it. Because all the moves are not going to be in the indices, they're going to be in the sectors. And on to the sectors. This is my trusted momentum indicator for XLF. You can see what the market has been doing, what the yield curve has been doing. I expect a steeper yield curve, therefore I expect this to go further up, which means that at some point I have to expect that XLF is going to go and fill all these gaps to the upside, probably go all the way up to these levels. So we're, the XLF not a sell, XLF a buy, and potentially the most interesting spread relationship out there for Monday. Make a note of these levels. This is transports against the energy sector. You can see the monster trend we've been in, and you can see where we've closed. I mean, basically it's been respecting this channel more or less, hasn't it, for years. And we closed right at brand new all-time highs. Now that could get reversed very, very sharply. Make a note of 309 and make a note of 294, which are the averages. We could get a monster move like we got here, or here. We could get a move of approximately 8% even on Monday. So that is fundamentally where I expect it to happen. The transports are very, their highest cost is fuel, and XLE, well, that goes without saying, it should be bid. Therefore, that is the spread relationship which I expect to be the most affected, and I will be tweeting about it on Monday. In NQ, I just don't see what people are getting excited about. I mean, I really don't see it. What is so exciting about this chart? It broke through, came back, tested it, went back up. It's just meandering. To me, this is not impulsive. The risk of NQ is so high that the reward is nowhere near as good. I would leave this well alone, or even short it against something like the Russell, which is very heavy in the things that which should go up most, which is the financials and the energy stocks. Russell against SPY. I would expect a move down to this kind of level, 187. So that is 1.5% on Monday. 1.5% to 2%. Could be very, very interesting. And certainly I wouldn't want to have a position at that level. It's been very, very good, hasn't it, in terms of how strong it has been. In terms of the retracement, we tried to do a very little retracement here of this move, failed, and I think that is the natural level that it's going to go to, this 187 area, where the very strongly sloping 200-day moving average is. That should catch it on Monday, and certainly if it opens, 190, it could go all the way down to 186, so that's another 1.5% from the open. What about volatility? Well, first stop should be this 1560 to 1625 area, and we cannot exclude that it trades there, and that would really basically coincide with a back up to around the 2960 area, maybe just a little bit lower, but really, if we expand this, we will see that this area here is going to be key. 1625, whether we close above or below it, is going to be very, very important. We've tried so many times to close above it and failed, that this area is going to be very important. At the moment, I don't see it. I think it's going to take some time for the market to decide. So I would have thought that 1625 area is going to be toppish for volatility, and that also basically tells me that the 2952 area is going to be very hard in SPX to be broken straight away. Logically, the index that should get hit most is the DAX. It is full of the companies that are going to be suffering the most if the oil price is going to go much higher and stay elevated or trend higher. As I've said many times, the market cannot possibly decide that in a day. It's going to take a long time. But the retracement in DAX should be one of the strongest. And, you know, we could see it all the way back down to this 11,720 level over the course of the next couple of weeks while the market decides what the hell it's going to do. In this area, I don't think is going to get broken. This 11,650 is going to be very, very tough for the market to break, and there is no reason for it, absolutely none. But I would have thought on a spread basis, DAX is going to remain weak for the next couple of weeks while the market decides on the long-term trend. Well, what are the biases for next week? After 2-year note, the support level is 170 and resistance 192, but that is the sector I will favor, together with the euros, something like Euro 3 or Euro 4. FV 180 to 188 is that area that I showed you on the weeklies that I would find it very hard to believe that we break without, like a knife through butter. That is worth a long, maybe through options, but it's certainly worth giving it a go at that level. The 10-year, the one that I'm actually long of, is actually difficult to say. I cannot now exclude the back up to 202, 203. Simply because we are going to be in a steepening environment, and only after the Fed has done whatever it's going to do, but we all think it's going to be 25 basis points, will we be able to tell. SPX, I showed you really what it's going to do. It's really going to move much more inside the sectors and against the other indices, and that will dictate its absolute level. But 29.52 I think is going to be very hard to break, simply because I think also VX is going to find the 1560 to 1625 area very difficult to break, and in which case you want to be trading the spreads against the RUT, against NQ. NQ, when you think about it, together with the European equities, i.e. DAX rather than stocks, because stocks has some oil component to it, while DAX has absolutely nothing. That should really suffer the most. I would keep out of the way of NQ. I certainly don't think the higher risk that NQ has is being rewarded by price, and therefore I would avoid it. RUT, if it opens basically in line with SPX, is the one that you really want to buy, I would have thought. And the dollar, I told you what I think. 111.08 is still very much key, but the impulsion there is weak. What we want to see is several days of the dollar closing at its Bollinger Band, and then it can start expanding it, and then we can get an acceleration. Fundamentally, we have the reasons for an acceleration, but we are just not seeing it in price. And I'm not going to be married to a view unless price confirms it. Thank you very much indeed, and tweet to you first thing on Monday.